In 2008, a 24-year-old put $1,000 into an index fund and never touched it again. He didn't check it, didn't panic sell in the crash, didn't wait for a better entry. Today, that $1,000 is worth $9,400. His coworker, same age, same salary, way smarter about the market, tried to time it perfectly. He's up $340. Same market, same 15 years, a 27 times difference. By the end of this video, you'll see exactly what the smarter guy did wrong and why almost everyone watching this is about to make the same mistake with their first investment. Meet Marcus and Jordan. Same job, same $500 a month to invest, same 2008. Marcus does what feels responsible. He reads, he waits for the right moment. He wants proof the market's safe before he puts a dollar in. Jordan does something that looks reckless. He invests on day one, knowing full well the market might drop the next morning. And it does, almost 40%. Here's the open loop. Why would the reckless guy win? Second loop. There's a number both of them are staring at right now that decides everything. And it's not the S&P 500's price. It's not even close. Third loop, one of them makes a phone call in October 2008 that costs him 6 figures over the next 15 years. We'll show you that exact call. Stick around. This isn't a lecture on index funds. It's the story of one decision that splits 2 identical lives into 2 very different bank accounts. Marcus is waiting for a signal, a green candle, a headline that says recovery confirmed. Here's the problem. That signal doesn't exist. Not in 2008, not ever. The stock market bottomed on March 9th, 2009. Nobody rang a bell. In fact, that week, unemployment was still climbing. GDP was still shrinking. Every rational data point said, wait, the people who bought that week weren't smart. They were just in. And here's the stat that should scare you. JP Morgan tracked the S&P 500 from 2003 to 2022, 20 years, 5,000 trading days. If you missed just the 10 best days, your total return was cut in half, 10 days, out of 5,000. But here's the catch. 6 of those 10 best days happened within 2 weeks of the worst days. The bounce comes right after the crash, when everyone's still too scared to buy. So Marcus, waiting for safety, is actually waiting for the exact window he's guaranteed to miss. October 2008. Marcus finally invested just 3 weeks before the crash accelerated. His $3,000 is suddenly worth $1,800. He calls his brokerage. Get me out. This is the moment. Not the crash, the call. Because here's what the data shows. Fidelity did an internal study on which accounts performed best over a 10-year stretch. The top performers weren't the aggressive traders. They weren't even the cautious ones. They were the accounts belonging to people who had died and the accounts of people who had simply forgotten they had an account. Let that sit. The best investors statistically weren't making decisions at all. Marcus made a decision. He sold at $1,800, locked in a 40% loss permanently. Jordan did nothing. Same drop, same $1,800 balance on paper. But paper is the key word because he never touched it. Pattern interrupt. Quick question. If losing money on paper doesn't cost you anything unless you sell, why does it feel like it does? By 2013, Jordan's portfolio, the one that dropped 40% in the crash, crossed back above where it started. By 2019, it had tripled. By 2024, that original $3,000 was worth just under $19,000. Marcus, meanwhile, had been sitting in cash since 2008, waiting for the next safe entry point that by his own logic never technically arrived. Inflation alone had quietly taken 35% of his purchasing power. He didn't lose money by making a bad investment. He lost money by refusing to make one. Here's the number that matters more than any stock price. Time in the market measured in years held, not days traded. A Schwab study found the difference between perfect timing and immediate investing over 20 years was less than half a percentage point of return. The difference between immediate investing and waiting in cash was over 100%. But here's where it gets uncomfortable. VO. Don't copy Jordan blindly either, because Jordan got lucky in one specific way. He could afford to lose that $3,000 completely and still pay rent. That's the variable this video almost let slip past you. The real decision isn't time the market versus don't time the market. It's this. Money you need in the next 3 years should never be in the market at all. Not because of timing, but because of when you're forced to sell. The 2008 crash recovered in 5 years. If Marcus's rent money had been in that fund, he'd have been forced to sell at the bottom, not by fear, but by necessity. That's the real killer. Not bad timing, bad placement. This is the twist coming. Hold that thought. Here's what nobody tells you in the Just invest early advice you've heard 100 times. It was never about picking the right day. It was never even about Marcus versus Jordan or who was braver. It was about which one of them had already built a cash cushion before they invested a single dollar. Jordan wasn't reckless. He'd already covered 6 months of expenses before that $500 ever touched the market. Marcus hadn't. So every drop felt like an emergency, because for him, it secretly was one. The entire time in the market beats timing the market rule only works for money that's allowed to lose in the short term. Invest money you can't afford to lose, and the statistics stop protecting you because you'll be the one forced to break them. So here's exactly what happened to that 24-year-old from the start of this video. He wasn't smarter than his coworker. He wasn't calmer. He'd just already secured his rent money elsewhere, so the market's worst month couldn't touch his decision-making. His coworker was trying to outthink a system that isn't designed to be outthought in the short term. That's the whole 27 times gap, not intelligence, sequencing. If there's one sentence to remember from this video, it's this: the market doesn't reward the people who predict it. It rewards the people who can afford to ignore it. If you want to know exactly how much cash cushion you need before you invest your first dollar, and the number is smaller than you think, that's next video. See you there.